let's dive into Investment 101, and we're going to talk about stocks, bonds, and funds, and where those fit into the equation of building wealth. So let's start with a stock, and we'll define it. According to Investopedia, a stock, also known as an equity, represents the ownership of a fraction in an issuing company. By owning stock, you become a shareholder and you get to participate in the gains and possibly losses of that company. Now, maybe that doesn't sound as simple as it could be, so let's restate what a stock is. To me, a stock is when you own a part of a business. So let's think about Apple, and let's just imagine a house, and let's say that represents Apple headquarters. When you buy Apple stock, you're essentially buying into a little piece of their company. So if we think about the picture of a house, a little part of that house belongs to you. So let's say Apple's share price, which is the value of its stock per unit, is $100. If Apple makes a lot of money and their profits go up, your profit goes up too. If they lose money and their profits go down, your profits go down as well. And if Apple goes out of business, then you're not really looking so hot. You might lose all your money, or you might get some back after they pay off their debts. So again, buying and owning stock literally means you own a part of the company, albeit a pretty small piece. Next, we'll talk about a bond. Again, according to Investopedia, a bond is a fixed income instrument, and it's an investment product where an investor lends money at a certain interest rate for a particular period of time. Over time, the investor will get back their principal that they put in plus interest. Again, to make it simple, a bond is like an IOU. So let's say you give $10,000 to the government. The government will then say, hey, Terry, I like you. I'm going to give you back your $10,000 in a year. And to thank you for loaning us the money, we're going to also give you back 4%. So I gave $10,000. A year later, I got it back, plus my 4% interest. So the total I received back was $10,400. And that's exactly how a bond works. As an investor, you're just giving money to the government, to other companies, to other people, towards mortgages, and hopefully you get your money back plus some. Now, there's lots of bonds, from really safe to really aggressive, and the interest you get back depends on how risky the bond is. But at the end of the day, it's as simple as loaning money and getting your money back plus some. The third category we'll talk about are called funds. In the past, we pretty much exclusively called these mutual funds. Nowadays, they're exchange-traded funds or index funds. A fund is basically a bucket, and within this bucket you have lots of stocks or you have lots of bonds. And you could have stocks and bonds in the same bucket. You can have a bucket that's just technology stocks, a bucket that's just electronic vehicles and robotics. It could be really anything. But again, at the end of the day, the fund is just a bucket where you put stocks and or bonds. So by investing in funds, it allows you to buy, say, 100 or 500 companies, little tiny pieces all at once, instead of just buying a little tiny piece of Apple or Amazon or Tesla. In general, funds are the best way for most people to get involved with investing because they can earn great returns while being really diversified and having their money spread out across tens, if not hundreds of companies. So thanks for tuning in. This was Investing 101.